Good evening. I hope you all had a fantastic day. Today, the market took a bit of a beating. The Nasdaq ended the day down lower by 0.86%, while the S&P 500 fell 1.08%, and the Dow performed the worst, being down 1.51%. States are beginning to feel the effects of COVID-19 and its impacts on the amount they will receive in taxes, putting pressure on funding to government-backed services. The CARES Act, which was set in place by the government, provided a $150 billion relief fund to help states and cities handle the pandemic. The Federal Reserve even established a program in April to purchase up to $500 billion worth of state and city debt. Regardless, quote, states are facing significant increased spending demands, sharp revenue declines, and all states are facing budget gaps and shortfalls. If we do see additional federal aid, it could lessen the need for budget cuts in some of these areas, such as public safety, healthcare, education, transportation. Also, additional federal aid would help with the overall rebounding of the national economy, end quote, said Brian Sigritz, Director of State Fiscal Studies at the National Association of State Budget Officers. The U.S. House of Representatives approved an additional $1 trillion worth of aid to state and local governments as part of a new $3 trillion coronavirus relief package, which was passed in May, but Senate Majority Leader Mitch McConell did not take up the proposal before the July 4th recess. State balance sheets have caught the attention of credit agencies, but so far, no state has been downgraded. Quote, states themselves have strong powers to make budgetary adjustments through cuts, revenue increases, and shifting costs to lower levels of government, but the historic crisis will substantially test the options, end quote, according to Moody's. In foreign economic news, the EU lowered its 2020 and 2021 GDP estimates. They're expecting a contraction of 8.3% this year, followed up by an increase of 5.8% in 2021. Quote, the economic impact of the lockdown is more severe than we initially expected. We continue to navigate in stormy waters and face many risks, including another major wave of infections, end quote, according to the Vice President of the European Commission. Italy is projected to contract the most at 11.2% this year, while both France and Spain are also projected to contract close to 11% as well. Germany has been the only country to see its GDP get revised upwards, and are now expected to contract by 6.3%, down from a previous projected contraction of 6.5%. Quote, since spring, the German government took further sizable measures to stabilize the economy in the wake of the outbreak of the pandemic. The initial response in March included vast liquidity support for companies in the form of public guarantees for loans, tax deferrals, grants for small businesses, and extended and simplified access to short-time work schemes, end quote, according to the Commission. Currently, the EU is working on a fiscal plan. However, there has still not been a compromise made between the 27 different members. Quote, the policy response across Europe has helped to cushion the blow for our citizens. Yet this remains a story of increasing divergence, inequality, and insecurity. This is why it is so important to reach a swift agreement on the recovery plan proposed by the Commission, to inject both new confidence and new financing into our economies at this critical time, end quote, said the EU's Commissioner of Economic Affairs. Cleveland Federal Reserve President Loretta Mester said that economic activity is beginning to slow in her region as coronavirus cases rise. She also believes that more policy help is necessary to get the economy through the pandemic. She said, quote, we saw a reopening in May, and activity is starting to come back pretty well. Over the past week or so, there's been some leveling off, and I think it's probably due to the increase in cases, not only in Ohio, but across the country. I think it's going to be a long road back to where we were in February. That's why the Fed has been saying we're here with our tools and we anticipate heavy and very accommodative monetary policy for quite some time in the future, because it's just going to take a long time to work through this. If we don't get further fiscal support, things won't come back as well as they could. This is a period where we need to be supporting both individuals and businesses who, but for the virus and pandemic, would have been healthy, to get them through this period so we can have it more grounded recovery and try to get back to where we were in February. In addition to these comments, the head of the Federal Reserve in Atlanta warned about the comeback of the economy and said, quote, "There are a couple of things that we are seeing, and some of them are troubling and might suggest that the trajectory of this recovery is going to be a bit bumpier than it might otherwise." End quote. It was reported that hiring was very strong in the month of May. Job openings totaled a tad under 5.4 million for May, while being up from 5 million in April. Hirings rose to 6.5 million, being up from 4.05 million in April. The layoff rate fell drastically, as the rate was at 5.9% in April, but just 1.4% in the month of May. Though, it runs a month behind the more widely publicized non-farm payrolls reading. The JOLTS report is a favorite gauge of the Federal Reserve policymakers. The quits rate, seen as a gauge of worker confidence, increased to 1.6% from 1.3% in April, but is still down from the level of 2.4% from a year ago. Florida remains to get hit hard by the coronavirus, and hospitals are now beginning to run out of hospital beds. Overall, the state's hospitals are now running at 78% capacity. Later in the day, Trump held a meeting about reopening schools in the fall. He seemed eager to have schools open, saying, quote, "We're very much going to put pressure on the governors and the schools to reopen," end quote. Dr. Fauci has also shown support for opening schools back up, saying, quote, "We should try the best as possible to get the children back to school, and the schools open for the simple reason that the secondary, unintended consequences of having children not being able to go to school has ripple effects for the family that might have effects that really override the so-called safety benefits," end quote. All sectors were hammered today, besides basic materials, which was barely in the green. Oil and gas had the worst day by far, being down more than 3%. Financials and industrials also suffered. Again, we see the rough day in the market was felt by everyone. Small cap value took the largest hit, as the basket of stocks were down 2.86%. Value and small cap as a whole took the largest beatings today, while large and mid cap growth performed the best. The best performance in the S&P 500 came from mega retailer Walmart. Shares gained 6.78% as the company announced that they will be launching a same-day delivery service called Walmart Plus. The service will be priced at just $98 per year, while this is lower than Amazon's price tag of $119 per year for Amazon Prime. The service will have more perks than just a delivery service, as it plans to add discounts, deals, and video entertainment. The second best day came from Rollins, which is a company that specializes in termite control. Shares gained 6.71% as the company announced that they are expecting revenue in the second quarter to grow by low to mid-single digits, against analysts' expectations of revenue taking a hit of 7.8% in the second quarter. The worst day in the market came from TechnipFMC, which is an oil and gas company. Shares were down 7.9% during the regular trading day, but have now exploded upwards due to news that TechnipFMC landed a $1 billion+ contract for a project in Egypt. The other loser was United Airlines, which had shares fall by 7.55%. This morning, United warned on recent booking declines and potential furloughs. On top of this, the Treasury announced that the U.S. airlines have signed letters of intent on terms for federal coronavirus loans. Do note that the airlines are not forced to take the money set aside by the government, even with the signing of the LOIs. Getting into earnings, we start off with Paychex, ticker symbol PAYX, which is a provider of human resource, payroll, in benefits outsourcing services for small and medium-sized businesses. Paychecks had a double beat, but didn't beat estimates by a large margin. Non-GAAP EPS beat estimates by 1 cent, as they came into the quarter with a gain of 61 cents per share. Revenue came in at $915.1 million and beat estimates by a small $4.42 million. This represented a decline in revenue of 6.7% on a yearly basis. Operating income also beat estimates. Looking ahead, Paychex said it expects fiscal year 2021 adjusted EPS to drop 6% to 10% on a year-over-year basis, and sales to drop 2 to 5% year-over-year. Current Wall Street price targets are for $70.17 per share, and the vast majority of ratings have it as a hold. Shares finished the day down nearly 5%, as investors were expecting more. Lastly, we have Levi Strauss & Co., ticker symbol Levi, which is an immensely popular American clothing brand, known for their Levi's denim jeans. Levi had dismal earnings today as they missed on both revenue and EPS. Non-GAAP EPS was a loss of 48 cents per share, missing estimates by 2 cents. Revenue was down a horrific 62% on a year-over-year basis as they finished the coronavirus-ridden second quarter with a revenue of $497.54 million, also missing estimates, but by $21.65 million. Levi missed on gross margin by a large amount as well. They also announced that they'll be slashing about 15% of its global corporate workforce, impacting about 700 jobs as an attempt to save money during the pandemic. Currently, they have about 90% of their stores up and operating. Shares are acting volatile after earnings, and shares of Levi were trading down 3.75% before the earnings report. That is all that I have for you tonight. As always, I appreciate your time and hope you have a nice rest of your evening. I'll see you again tomorrow.